the financial transactions that your business does. And it basically gives a yay or nay for people who are interested in working with you. So for example, banks, lenders, like banks, investors, business partners, they're going to ask you, let me see your financials. You'll see that, you heard that a lot in movies. They'll say, hey, let me see your financials. So they come out, the owners come out, they give a bunch of paperwork, and that is what accounting does. Is accounting is a bunch of financial statements that shows how well your business is doing or how bad your business is doing, so that the people that you're working with can make a decision whether or not to work with you. So that's what, I'm just simplifying it, but that's really what accounting is. So here's the foundation of accounting. Now there's two different types of accounting, right? I mean, there's a small business accounting and there's corporations. So most of our family members work for big companies. So they have what you call, I don't know if you guys see my mouse, but so for corporations and sole proprietorships are those who are starting a small business. So most of us, when we start a business, we're not going to have a big corporation. We're going to start small. So our foundation, our formula would be assets equals liabilities plus owner's equity. And we're going to go over that in a second. For corporations, it's assets equals liability plus stockholders' equity. Owner's equity means us, because we're one owner. Stockholders' equity for corporation are usually the stockholders, right? Those who invest into the, so like, for example, let's say Facebook, right? They have, when Facebook went public, so let me elaborate. Sole proprietorships are usually private companies. So when I start a company, I'm a private person. If I decide to go public, I become a corporation. And when I go public, so when Facebook went from a private company owned by college students and they said, let's offer a piece of our company to the public. So they offered it for public, and you have all these investors who invested in stocks in Facebook. Do you guys remember that? So those who bought stocks for Facebook are part owners of this corporation. So if you look at the bottom here, stockholders are all those little owners that own the corporations, what money that they invested. That's what the equity is. And hopefully that makes sense. So owner's equity is our investment because we're a private person. Stockholders' equities are the investment of all the people that invested in the corporation. So it's just multiple versus singular. Hopefully that didn't confuse you, but we're going to elaborate some more. So here's a few keywords that you need to understand. Assets are what a company owns, are things that a company owns. It's basically, I own it. Liabilities are what company owes. So for example, if I'm renting a car, that's a liability. I haven't purchased the car yet completely. I don't own it yet, so that's a liability. Whereas if I have a truck for my business and I paid it off, that would be an asset because I technically own it. The bank doesn't own it, okay? Then you have the owners or stockholders' equity is basically the difference between assets and liability. So depending on how much, so for example, if I'm the owner and I own this building, I own the car, I own, all this, like, let's say a building and a car for my business. Then my liability is I owe money for the land. So my equity would be the building plus the car minus the land. That is my equity. So it's whatever I own versus how much I owe. That will be my equity. So it's whatever the corporation owns versus what the investors or the stockholders own. So it'll be what we own and what they owe. So sorry, what the stockholders own and what the stockholders owe. So you subtract that, that will equal your equity. And again, that might be confusing, but I'll go over. So which of the following are assets? This is a question for you guys. Remember, assets are things that you own. So Letter A. Are these all assets? Cash in the bank.
That is.
Money owed to you from customers.
Money owed.
Yes.
Building and equipment?
Yes.
If you own it, then yes.
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 Right. So those are all assets. Okay, how about let's look at B. Money you owe to others.
No.
No.
Loans from the bank.
No.
No.
Buildings, so that's not the answer. Part C. Products in your warehouse.
Yes.
Money owed to you from customers.
Yes.
Staff salaries?
No.
No.
No. So the answer is
A.
A. Good. So that's what assets are. Okay. So now when you talk to people, they're like, oh, do you have any assets? You know what they're talking about. When they say, yes, I have assets, that means these are things that they own. Next question, liability. Which of the following are all liabilities? Let's look at letter A. Money you owe to suppliers.
Yes.
Interest you owe to the bank.
Yes.
Yes. Product in your warehouse.
No.
No.
Okay, so that's not the answer. Letter B. Money you owe to suppliers.
Yes.
Yes.
Money customers owe you for work already done.
No.
No.
Okay, so that's not the answer. So I wonder what the answer is. C. Interest you owe to the bank, salaries for your staff, and money you owe to your suppliers. Those are all liabilities. Okay? So that's to simplify it, right? So what are financial statements? So financial statements is basically a way for people to know how well you're doing. For example, you send it to your management. So most of the time when you have your leaders, let's say you're an owner, an executive, you're gonna have directors, VPs, all these people under you, and you're gonna say, here are the financial statements. So you're basically showing them your numbers so that they will know how bad you're doing or how well you're doing. I just simplified it, but that's the gist of it. That's the purpose of financial statements. It's kind of like a report card on how your business is doing. It's also what the IRS looks at. So when the IRS looks at your documents, so when they look at your taxes, they'll say, let me see your financial statements. That's when you submit all your financial statements, and they'll tell you how much taxes you owe based on the financial statements. Okay? So there's 3 important financial statements that as a business owner, you should understand. You should know the basics, and you should be able to read it. It doesn't matter if it's a big company or a small company. These 3 documents is very important. And we're going to go over them very specifically, okay? The first one is the profit and loss statement, also known as the income statement. Then you have the balance sheet and the statement of cash flows. Now, if you have a very small business, you see I made a note here, a profit and loss statement and a balance sheet is usually what is required. The statement of cash flows is typically for bigger corporations, but the smaller businesses, if you just, most of the time as an IRS, if you have a small business, will just say, send me your P&L statement and send me a balance sheet. So what are these statements? So I'm gonna break it down. So the first one is the profit and loss statement, also known as the income statement. This is basically a summary of your revenue and your expenses for a specific period of time. So they'll say, send me your profit and loss statement for the month of April. Or they'll say, send me your P&L statement for quarter 2. So it's taking your revenue and your expenses, which equals profit or loss. So it'll be revenue minus expenses equals net profit or net loss. And then we're gonna elaborate some more. So accounting balance sheet. So the first statement is a P&L statement. The second statement is a balance sheet. The balance sheet is a list of all your assets, all of your liabilities, and owner's equity. We talked about this, right? Earlier in the beginning. A balance sheet is just a summary of all the assets, everything that the company owns, the liabilities, everything that the company owes, and you subtract that from each other, assets minus liability, which equals the owner's equity, which is what is left over, and whatever you invested. So you have your investment. So I invested $100,000 in my company. And let's say the assets minus liability is 10,000. So the total equity would be 100,000, which is my investment in the company, plus the 10,000. So it's 110,000. And we'll elaborate. We'll show you actual visual pictures. I'm just giving you as an example. And the third statement is cash flows, statement of cash flows. Basically, this is when a statement of cash flows is exactly what it sounds like. It tells the people where your cash went. It tells the people how much cash is coming in and how much cash is leaving your business. So that's the summary of what it is. It's cash receipts and cash payments. Because remember what I told you guys from the very beginning, in personal budgets, cash is king. All investors, all partners, everybody that's looking at the success of your business, they want to know how much cash do you have in the bank? How much cash do you have that you could basically get access to right now? The more cash in your business, the more solid your business is. It's kind of like in personal, right? The more cash you have in your personal savings and your investments, the more solid your personal finances. It's the same thing with business. So why are financial statements important? Understanding financial statements is one of the key. I'm going to mute you all just a little bit because I hear some background noise. Okay. Understanding financial statements is one of the keys to your small business success. And here's the reason why. Most entrepreneurs fail, not because they lack knowledge of their products and determination, but because they fail to realize the importance in preparing their financial statements, analyzing their financial statement. A lot of time what you'll find is you'll hear people say, that these successful, billionaires and millionaires, they'll say, what are your numbers? Do you know your number? What's your net worth? You hear people say, so-and-so's net worth is $0.6 billion. It's just basically how much assets they have, how much money they owe. So assets minus how much they owe, that's how much their net worth is. It's kind of like that. So this is for the business statement. It's just like profit and loss. Okay, so now let's elaborate on income statement. I'm gonna mute y'all. Okay. So we talked about income statement is revenue minus expenses. So if you have revenue minus expenses, it's either going to be a positive number or it's going to be a negative number. If it's a positive number, that means your business is profitable. If it's a negative number, that means your business is not profitable. So the purpose of an income statement is to tell you how much cash is going in and how much cash is going out of your business every month. And the whole point of an income statement is to let you know if you have a net profit or a loss. Profit and loss statement is the same thing as income statement. So now we're going to play a game. All right. Okay, Asia, I can't unmute you for some reason. Okay, there you are. Okay. Oh, no, I clicked on something. Darn. Okay. Well, which of the following is not considered part of a business operating revenue? So I know you guys saw the answer, but is the sale of a product revenue? So revenue means income coming in. So it's money coming to you. So when you sell a product, is that income coming in?
Yes.
No.
Yes.
Yes.
Yes. So when you sell a product, right, people are going to buy the product from you. So yes, they will receive the money. You will receive the money. Fees for services provided. Is that income coming in?
Yes.
Yes. So you provide a service. Like for me, I coach, they pay me. That's income coming in. So a revenue is basically money that's coming into you to pay you. Okay? Money paid to your employees. Is that a revenue? No. Why? Because you're spending it.
Mhm.
So revenue is you're receiving it. Expenses is you're spending it. Let's go to the next question. What are operating expense? Okay. Daily expenses incurred in the operation of your business. So a lot of times people are like, okay, what are your operating expenses? What's your expenses? So these could be insurance costs, legal fees, office supplies, property taxes, rent, repair, phone bills, salaries, advertising, basically anything that you need to pay or spend in order for your business to run. These are all operating expenses. So think of it, bills, 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 right? You got to pay somebody's salary, that's a bill, right? So let's look at some examples, guys. So here you have Paul Guitar Shop. This is his income statement, okay? Remember what we said. It's revenue minus expenses equals net income. So revenue is he sold some merchandise. That's $24,800. That's how much sales he had for the year. So that's an income, so that's revenue. Then you have music lessons income. So there's a service provided, right? So merchandise and service provided, $3,000. So the total income, total revenue was $27,800. If you look at the expenses, there's several, right? You have depreciation, wage, rent, interest, supplies. So these are basically all his bills. So income coming in minus the bills. So that they added up the total bills. It's $14,850. To get the income, the net income or net loss, you take $27,800 minus the $14,850. That equals the net income or the net loss. So for this business, did he do well?
Yes.
Yes.
Yes, because it's not a negative. If it's a positive number, that means they did well. So if you guys notice, I highlighted cost of goods sold. Does anybody know what cost of goods sold mean? No? Okay. So I'm going to mute you guys real quick because I see background noise. So the cost of goods sold is basically the total of all costs used to create a product or service which has been sold. So anything and everything that it takes for that product to be sold, that is a cost of goods sold, right? So for example, direct labor. So let's say I have this phone, okay? You guys see this phone? The person, all the labor expense that took to make this phone is part of cost of goods sold, right? So let's say usually they make this in China. So those laborers in China who's making this phone is part of cost of goods sold, okay? If I'm paying, let's say I own a Sprint store. If I'm paying a sales associate to sell this phone, are they a cost of goods sold? No, because they're not the ones who made the phone. They are my expense. They are my operating expense. So there's a difference. Got it? So you have the people who are making the phone. That would be a cost of goods sold because that is direct labor. They're actually the ones who made the product. And expense would be me paying my sales associates to sell the phone. That is an operating expense. So cost of goods sold is they actually had, they're the reason why I was able to sell the product. Materials, for example. So you have the case, the little buttons, for example, or the little gadgets inside the phone. That will be part of cost of goods sold. It would not be an operating expense. It would be part of, because that's what I needed those parts in order for this phone to be made. Okay. Does that make sense, guys? You got it? Okay. All right. So So like, so examples of these would be, for services would be labor, payroll, benefits of the people generating bills. So cost of services. So, so for example, if I'm providing a janitorial service, the laborer who actually cleans the floors, that would be cost of goods sold, because my service is janitorial service. So it takes the janitor to do the work in order for that service to be sold. I hope it's not confusing, but that's the difference between a merchandise. So the people who make the product is the cost of goods sold. And if you're providing a service, for example, cooking or cleaning or whatever else, car wash, they would be a cost of goods sold because it takes them for the services to be sold. Okay, and overhead, you saw overhead right here. The third category is overhead. So direct labor, materials, and overhead. Overhead is basically administrative expenses that cannot be definitively attributed to any revenue generating activities. So just call them admin costs. So for example, accounting, administrative salaries, insurance, legal, rent, utilities. So for example, to sell this phone, does it take rent for this phone to be made? No, it's just overhead. Rent, it has nothing to do with the phone. It's just, I need an office to put the phone in, right? Now, does it take, I don't know, like for example, this headset to go with the phone, would that be overhead? No, because people actually use this to buy the product. Okay. All right. So here's your game again. Here's a question. Which of the following is considered part of a business operating expense? Okay. I'm not gonna, you guys can look at it. What is an operating expense? Remember, we have operating expense versus cost of goods sold. So which example is part of the business operating expense? Okay, so let's see.
Hey,
Go ahead. Can you all see?
can we answer?
Yeah, you can answer.
Wouldn't it be A?
A.
Mhm.
Anybody else? You're right. It is A. Money made from selling products is not an expense. Interest it earned from money in the bank, not an expense. It's A. All right. So here's an income statement example again. Right? So to take this home. Revenues minus expenses, cost of goods sold. So now you can guess. The cost of goods sold is probably what it took to make the guitars. Remember how he sells guitars?
Mm-hmm.
So that is what it takes for him to make those guitars. That's $10,200. So the cost of goods sold plus all the expenses equals total expenses. So the revenue minus expenses equals the net income. Now, when you guys look at income statements, it doesn't matter if it's a big business or a small business, you're going to say, let me see your income statement. Now you're going to know, oh, there's your revenue, there's your expenses. You take revenues minus expenses. It will determine either your net income or net loss. If it's a positive number, it's net income. If it's a negative number, it's a loss, right? And now you know what the definition of cost of goods sold is, because a lot of times this income statement will break it up. They'll break up the cost of goods sold versus the rest of the expenses. Is that clear?
I have a question.
Go ahead, Kate.
Okay, so you talked about like employees that directly do the service and employees like administrative being an overhead.
Mm-hmm.
What about like other employees? Because I guess
example,
like
HR.
Like what about like publicity and that kind of stuff? That's not administrative.
So that would be just an expense, not a cost of goods sold. So it would be like,
okay.
yeah, cost of goods sold is basically what it takes to make the product.
Okay.
Overhead is like administrative and all this stuff, but it would just be kind of like here, wage expense.
So
You
it's
see the-
basically necessary.
yeah, it's necessary, but it's not part of cost of goods sold. Well, technically, it would fall under overhead because it's all the other overhead is basically anything that makes the business run. But some people say it depends on your accountant. Some accountants, remember, it's all about the accountants you pick. They lump it up